Watch this before you scroll through Rightmove. So before scrolling through Rightmove, it's really important to understand what's within your price range. A couple of factors which lenders look at when it comes to a mortgage are things like loan to value and your loan to income. We're now going to explain the difference between the two.
So what is loan to value? Loan to value is a percentage that you are borrowing against the value of a property. Let's give you an example. If you're purchasing a house for £100,000 and you're putting down a £5,000 deposit, meaning that you're borrowing £95,000, you are borrowing 95% loan to value.
When it comes to a mortgage, most lenders require 5% deposit when it comes to borrowing. The bigger deposit you do have, the better interest rate that you get. So for example, if you're putting down a 10% or a 15% deposit, again, the bigger the deposit, the better rates that you will achieve with your mortgage.
The level of deposit you're putting down on the purchase also affects the underwriting of your mortgage application. So let me give you an example. Potentially, the higher the deposit you are placing down on a purchase, the less underwriting that's involved because you're deemed as potentially less risk from a lender. However, if you have some elements of adverse credit on your profile, you may be required to put down a larger deposit in order for you to obtain a mortgage.
Also, when it comes to loan to value, the lower loan to value that you have, with some lenders, it will allow you to borrow more money. So for example, some lenders, when you are borrowing less than 75% of the property value, will allow you to borrow more money than if you was lending more than 75% of the property value. That can typically make a big difference when it comes to your mortgage application, because some lenders will lend you up to 5 times income when you're borrowing lower than 75%, whereas if it's above 75%, that income multiple may be only 4.5 times. There are also some mortgage schemes, such as shared ownership, which don't actually require a deposit. That means you are borrowing 100% of the property value.
So what is loan to income? Loan to income is a multiplier of the total household income a lender would apply to a mortgage application. For example, if you are borrowing £100,000 and your income is £25,000 per annum, that means that you are borrowing 4 times the annual household income. Most lenders will have a cap on the income multiples that they'll lend to any applicant. So for example, majority will have a cap of 4.5 times income. However, if your income is a lot higher, when I say a lot higher, it could be above £60,000, lenders may stretch to a higher income multiple. So we have seen income multiples anywhere between 5.5 and 6 times your salary. Also, if you're classed as a professional, so that could be a doctor, an accountant, or a solicitor, you may be eligible up to 6 times your salary.
There are other factors that can affect your loan to income. Those factors include things such as borrowing. So if you do have credit cards or loans or maybe car finance in the background, your income multiples can get reduced. So rather than a lender typically lending you up to 4.5 times your income, if you have got loans in the background, that may reduce to something like 4 times or even 3.5 times, dependent on the amount of debt that you have. The other things that can also affect your loan to income is if you've also got any dependents in the background. So you may have children, you may have childcare commitments that come along with those children. Those are also things that can also affect your loan to income. So the more dependents you have, the lower loan to income that you will get applied with a mortgage. Age can also have an impact on your loan to income. So for example, if you are close to retirement, that means that you have to have a shorter mortgage term, because generally lenders will only allow you to take your mortgage up to retirement. Therefore, if you've got a mortgage term of maybe only 5 or 10 years, then that will mean that they will allow you to borrow less than if your mortgage was, say, over 25 or 30 years.
Another factor that can impact your loan to income is using additional incomes such as overtime, bonus and commission. Now, some lenders will only take a portion of the overtime, bonus and commission. However, some may take a full amount of the overtime, bonus and commission. Obviously, if a lender is using the full amount, your loan to income is going to be higher. As well as bonus, commission and overtime, a lender may choose to use the household benefits that you also received. That can also boost your loan to income.
There is significant value in speaking to a mortgage broker when it comes to scrolling through Rightmove. The benefits of using a mortgage broker is most mortgage brokers have access to a comprehensive range of lenders. When you're scrolling through Rightmove, they have affordability calculators displayed on their website, which you are able to use. But generally, those calculators are only for one lender. When you go to a mortgage broker, the mortgage broker who can access a comprehensive range of lenders can usually find you better deals based on what you currently earn. That may mean that whereas the calculator on Rightmove says that you may only be able to borrow 4.5 times your annual income, there may be lenders out there that can allow you to borrow up to 6 times your annual income. Also, those lenders displayed on Rightmove might not be a lender that you are eligible for. It could be that you've got some bad credit in the background and therefore that lender isn't appropriate for you to use. It may be that the lender doesn't offer products based on the size of the deposit that you have. As I say, mortgage brokers usually have access to a wide range of lenders and therefore hopefully can get you the best deal based on your current circumstances.
So, some things to consider before you scroll through Rightmove. In summary, loan to value is a percentage of borrowing against your home.
And loan to income is the multiples that lenders apply to your income when you're looking to apply for a mortgage. And also, it's really important to speak to a mortgage broker when it comes to a mortgage, as that mortgage broker will have access to a comprehensive range of lenders.
So if you're looking to take out a mortgage, here's 6 secrets that every homeowner needs to know.